The information provided in this podcast is for educational and informational purposes only and should not be construed as investment advice. We are not financial advisors, and nothing discussed on this podcast should be considered a recommendation to buy, sell, or hold any security. All opinions expressed are those of the hosts and guests and are subject to change without notice. Listeners should do their own research and consult with a qualified financial advisor before making any investment decisions. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. All right. Hello, everybody. Welcome to the Value Seville Podcast, Season 2 of the Value Seville Podcast. I'm Jeff Hendrickson, your host, here with my co-host, Donnie Sitar. Donnie, how you been, man? Season 2, you ready for it?
Yeah, I'm doing great. Season 1 was fantastic. I'm really excited to take what we learn, apply it here to Season 2. And I'm excited. We're starting off really stretching you and I here. So real excited for today's interview here.
Yeah, well, I think anytime you want to get better at something, you have to stretch yourself, and you stretch yourself by getting people on that are smarter and better than you are, and you ask them intelligent questions. And I've got to say, Rick Carew, our guest today, first of all, let me tell you a couple things. So Rick has been involved with Value Seville from the start. He's an original gangster. He's been to all of our events. The past 2 years, he, with Fordham, has sponsored our Jeffersonian dinner. And he's just been a big supporter of everything we've done. And it's great to finally have you on, Rick. A little bit of background for Rick, for those of you listening that don't know him. He is a professor at the Fordham Gabelli School of Business. He co-leads the undergraduate fundamental investing program with Paul Johnson. He also oversees the Student Management Investment Fund program, which is a $2.6 million student-run fund at Fordham, which I think is a fantastic idea. I know at Darden, they do something similar, which is, you let students run money, real money, which you just really can't beat that type of experiential learning, I think. So he's got a large, really amount of experience in teaching value investing. Rick was also a reporter and a senior editor for the Wall Street Journal in Asia for 10 years. So he's well-versed in international markets, especially Asian markets. And so we thought to start Season 2, what a better way to talk about value investing in an international context. We have to have Rick on. He's gonna make Donnie, he's gonna make you and me work a lot harder, ask better questions. We're gonna get smarter because of it. Our audience hopefully will get smarter because of it. And we're really excited to have Rick here. So Rick, welcome to the podcast.
Well, you missed one thing, Jeff. I just want to make sure we get this in there. He's also one hell of an MC for a Jeffersonian dinner, 2 years running now. Yes. We loved having him and excited for the years to come. So I wanted to make sure we got that.
So they sponsor the dinner and Rick has run it and come up with the questions. And so, the Jeffersonian dinners have been fantastic with him emceeing it. And so if you need, Rick, I'm going to just put it out there. You might get some job offers on this. If you need somebody to host the Jeffersonian dinner, I mean, Rick, he's Mr. UVA. He can do it and he'll do a great job for you. But Rick, how you been, buddy? It's great to have you here.
I'm doing fantastic. Having a wonderful summer and really appreciate you, Jeff and Donnie, for having me on the podcast. When you said that about the Jeffersonian dinner, I was just thinking about our topic from the last one we had, this year's meeting. And, it was all about the AI trade, which of course, as we're recording this, there's been some wild swings in the markets related to investments in artificial intelligence. So it feels like it was on topic and something we worked on together. So really great to do that and really appreciate both of you building such a special community in Value Seville. One of the things that I've really enjoyed is inviting, as you've invited a lot of people onto the podcast who are part of the Value Seville community. I've actually invited a lot of them into our classroom to both speak to our students and then also talk with them about some of the great investment ideas they've shared at our annual gathering. So really appreciate both of you building that community and keeping it strong, and look forward to working together and having a great discussion today.
Well, look, I couldn't agree more with everything you said. I think the community that we've built, the caliber of folks that we have come to our events has been just so, for us, I think I can speak for both Donnie and me. We've learned so much by knowing folks like yourself and just doing the podcast. I'm going to come away today a lot smarter than I was when we started it. So here we're going to talk today a lot about value investing in an international context. And I think, maybe Rick, I did a little bit of background on you, but just to get a little bit more background about your specific experience, can you kind of talk about maybe a little bit about your teaching and also your time in Asia? And then kind of as we dovetail into how you view, applying a value framework in an international context.
Yeah, no, happy to do so. At Fordham Gabelli Belli Center for Global Security Analysis. So one of our core tenets is encouraging our students to think about how to invest in a global context. And I think it's become more and more, I wouldn't say obvious, but maybe easier for people to appreciate the importance of global investing when you think about what's happened in terms of the artificial intelligence world, where you've got TSMC, which is one of the most important companies there, based in Taiwan, which has become a sort of a geopolitical flashpoint as well. There's been a lot of developments going on within China in terms of what's happening with AI models there. So I think it's become much easier for students to really understand the importance of global investing. And we try to bring that into what we do in the classroom. We have a lot of guest speakers come in from London and from Hong Kong and India, other global markets. So we love bringing that sort of global perspective, which is something that, in my professional career, as you noted, Jeff, I spent a lot of time based in Hong Kong and covering markets and private equity and tech companies across Asia, all the way from Mumbai to Tokyo. So it's really core to what I find interesting and what I like to do, and something we're doing at Fordham and really focused on in part of our curriculum.
Yeah. One thing,
Awesome.
as we got, I really appreciate the background. I would say I would just kind of add is that when we've been able to have discussions around the edges, Rick, I think, you always have such a vast experience in markets that I just don't play in, whether it's China and Taiwan and other places like that. I know you're actually visiting them here coming up in the next month, I guess. You'll be gone. So you have this wealth of experience. But I guess like just one of the things that I think about, as we as preparing for this discussion is like my history of investing internationally. And, it's just like sometimes, I get burnt, or I just come to find out something that I think like in America would be steady state that is not steady state somewhere else. So there's an extraordinary amount of cash on a balance sheet. You think, well, wow, you could distribute this back. It's almost like a net, and you think it's great. And you realize that, well, there's a cultural reason why there's a lot of cash, or there's a board that's not really, aligned with shareholders and in some other locale and things like that. And so I always just end up back in the good old USA because I feel like I know the norms and the mores here. But I think you've helped me a lot. I think at least start to think a little bit better about that. So I'd love you to kind of, some discussions we've had informally, we could kind of formalize in here, and I'd love for you to kind of take us through maybe that value investor evolution of a guy who sits in the U.S. and then eventually can be comfortable enough to really go outside of his wheelhouse.
Yeah, sure. That's a great point, Donnie. I think a lot of people, when they first start to approach international investing, they really think about it as just buying a foreign stock, or they get into it because they've heard about a great idea, or they're exposed to one market or one concept. And I really I do this with our students, but I encourage all investors to really think a little bit more systematically about expanding your circle of competence. Don't limit yourself to one market with trading within one currency. And I'll make the case that actually global value investing is really the ultimate form of value investing. And what I mean by that is that there's greater inefficiencies, there's informational asymmetries, there's capital dislocations, and all of those are accentuated when you go beyond borders. So we've seen recently markets react to news that is coming out of China or coming out of foreign markets that's driving what's happening in the US. And there's a lot of nuance to the way markets work internationally that allows you, if you're somebody who is looking for the highest returns and looking to build a strategy that will work for you or for your investors, that having a global mindset is going to, in the long run, going to help you. And I'm not saying that, tomorrow you need to give up everything you've learned and just start to invest in, small caps trading below book in Japan, or going into Poland and buying auto dealerships there, or, doing anything like that. But what I mean is that if you're covering a sector, I'd encourage you to start to think about how the US companies that you cover compare to their global counterparts. So for example, I've kind of got 5 sort of key tenets to the way I think about global value investing. And the first is really thinking about how business models translate across geography, right? So let's say you're an e-commerce analyst sitting in New York or in San Francisco, and you're studying the growth of Amazon in the US market. Well, understanding that business model actually can be very powerful in helping you to achieve returns in other markets. So, for example, you could look at a company in Latin America called Mercado Libre, right, which is doing a lot of the same things that Amazon has done in the US and having a tremendous amount of success there. You could look at a company like Alibaba in China, and you could understand what's happening there based on the path that Alibaba sort of paved in the US. So in a lot of markets, you'll see there are analogies within local markets for local champions that emerge in different sectors. You can also look at franchise restaurant businesses, right? So McDonald's operates franchises around the world. Many of those franchises are publicly traded or owned partly by local operators. You could look, for example, at KFC, right? It's a brand that's worked around the world. They're owned by Yum Brands, which has a separately listed business in China called Yum China. And so there's a lot of ways that you can take the knowledge you've already built in the US and expand on that overseas. One of the earliest versions of this was the idea of buying the Coca-Cola bottlers in different markets. So if you wanted exposure to fast-growing markets, you could buy the Egyptian bottler of Coca-Cola or buy the Turkish bottler or, bottlers across Europe or other markets. And what you're doing there is you're getting opportunity to, in that case, to have a vetted partner who's already made an agreement with one of the more conservative, globally successful companies in the US and work with them in a local market. And then you get both faster growth and also some of the, tailwinds of the expansion of US consumer goods in global markets. So that's kind of the first example, is kind of translating global business models in other markets.
And just to pause on that point, because that, to me, I think I can conceptualize that. But how much would you say, for each of these examples you mentioned, do you need to understand the country really well, or could it be something that's widely applied? It's kind of funny you mentioned Coca-Cola, because I think it was when Buffett and Munger were making their investment in Coca-Cola back in the day, they were like, well, once Coca-Cola enters a country, it takes up a certain percentage of the liquids that are sold, or something like that. And they were like, well, you can see this huge runway ahead. And that didn't matter what the norms of the country were, or the rules in some sense. But how do you view these great business models you mentioned, if they're being applied somewhere else? Does the business matter more, or does the country matter more in some sense? How do you weight that, I guess?
Yeah, it's a great question. And this is, we'll talk a little bit more about this later in terms of currency and sort of understanding some of the macro dynamics that you have to be aware of. But I would say at the end of the day, these business models translate into almost every market. I mean, you can see Amazon is pretty strong in Europe, but if you look outside of that in other markets, they've been slower to go into Latin America. They've been shut out of parts of Asia, Southeast Asia. And also I'll point out to you, even though Warren Buffett has traditionally been a major proponent of, Buy America, S&P 500, his thesis really around Coca-Cola was basically built, as you kind of alluded to, around the idea that Coca-Cola was going to have a massive opportunity to expand in Europe when the fall of the Berlin Wall and the opening up of all of these former communist countries to U.S. consumerism. So there was a huge opportunity there, and that was a big tailwind for him in that Coca-Cola investment that I think is a little bit underappreciated in terms of what really made that investment successful.
Yeah.
Rick, when you think about what I think about this, there's kind of two challenges, right? Because on the one hand, I need to understand whatever business model that I'm analyzing, right? And if it's a Coca-Cola bottler in Eastern Europe, that's pretty easy to understand that business model. Same would go Didi, and rideshare in China. I mean, I get the business model. Where it becomes more difficult is understanding corporate governance in those countries. So when you are looking at something from an international perspective, where do you start? You start with wanting to unpack the corporate governance questions, maybe ahead of really understanding the business, or do you do it in parallel, or is it a sequential process where it's I have to and love the business. Okay, check that box. But now I need to really understand corporate governance, how capital is going to be allocated, and whether or not I've got a good management team that has my best interests, at heart. How do you think about unpacking those two separate dynamics?
Sure. So I think you always want to think about all of these things. These are all parts of the puzzle you need to put together, right? You can't really make the investment and then start to think about the corporate governance around it. But I also would encourage, investors, sometimes they can get a little bit stuck on some of the structural elements of it. So, for example, within the China context, there's a huge concern about VIE structures, right? Which is like, who owns these assets at the end of the day? Sometimes, look, there have been cases of fraud, especially in US listed Chinese small caps, which were basically packaged to exploit sort of retail investors who weren't sophisticated. But I would say for the larger companies, the Tencents, the Alibabas, the CATL, companies like an SK Hynix or a TSMC, some of these, it's easy to get caught up on somebody who's going to tell you like, oh, well, you don't actually own the underlying assets of the business. And, I say in response to that, I say, okay, I get it. It's a little bit quirky and a little bit more challenging. And you're right. In a bankruptcy scenario, you're going to have issues, right? But TSMC, are we looking at a bankruptcy scenario in your kind of like 95% of possible outcomes that you're going to have there? I don't think that's really within the spectrum of things you need to worry about. But what I would say that I feel very strongly about is when you look at the management teams of any business, this could be US or internationally, you really want to understand, do they talk to shareholders in a way that you feel like you're a partner in the business, right? This is kind of goes back to some of the more fundamental value investing principles. Is like, do they treat minority investors like somebody that's a partner? Do they respond to inquiries? You can get a lot of information just by reaching out to a company and figuring out how they respond to you. The second is, are they good capital allocators, right? A huge part of show me rather than telling me is, what do you do when your stock goes down, right? Do you buy back shares? Do you do nothing? Do you set your buyback policy based on stock-based compensation? By the way, a lot of the tech companies around the world do not have aggressive stock-based compensation the way their US peers do. So you might even find an advantage in terms of corporate governance. You look at the tech companies in Silicon Valley, most of those companies are founder controlled, and you have no chance in the world of ever running a proxy battle against Mark Zuckerberg at Meta, or upsetting corporate governance at Google. So make sure that you're clear about how you understand the companies you're comparing it to and the comparative base. You go, well, I can't influence the leadership at Tencent or Alibaba. And I go, well, are they buying the stock back when the stock's down more aggressively than they are when the stock's up? That's one indicator. Do they pay dividends? Do they return cash to shareholders? In fact, you'll find a lot of international companies, in order to attract more conservative investors in those markets, actually have higher dividend payouts versus their US peers. It cuts both ways in terms of corporate governance. And it's really important to sort of build a network of people that you can talk to. I call this the 5 guys method. I use this in something from investigative journalism that I picked up, which is, on any company or in any situation, you need to have a spectrum of at least 5 sources that you trust and can go back to that have a different perspective on the company. So if you're thinking about geopolitics, you might want to have somebody in your 5 people you talk to about Taiwan, somebody who's the geopolitical expert, right? Who can help you to understand what's going on with US, Taiwan, China dynamics. You might also want to have somebody who's a lawyer who can really understand, is there corporate governance structure or ownership structure out of line with the market? Or is it sort of standard practice of the way that investment bankers package every IPO, right? You'll find that in China. With the Alibaba IPO, everybody made the VIE structure a huge issue. And in reality, it was the way almost every Chinese internet company was structured. It's just that Alibaba was the biggest and did a record-breaking US IPO, so it got more attention than some of the others. You might want to have somebody who used to work at the company or advise the senior management team that can tell you, really, are these people who want the stock to do well, or are they a sleepy family business that's run by a 70-year-old patriarch who sold shares 20 years ago to the market in their family real estate business because they needed cash for something. They have no interest in making shareholders happy or listening to them or engaging, because the shares trade and they have control of the business, and they're not interested in in making shareholders happy. So, there's a lot of ways you can do to build confidence and understanding around different elements of legal issues, geopolitics, sort of management strategy, capital allocation.
Yeah, so that's super helpful. Because I think about in the States, the one thing was like that. Look, there's expert networks, right? And that's like additive information. But for the most part, it's all pretty much the same information. Reg FD came out however many years ago, and we were all getting like all the information at the same time. And so, how is the information in like a lot of these countries? Like, how do you like? If I'm kind of running blind into this now. You've kind of given me permission to say, look for good business models. I can do that. You've talked about like, hey, I've got a good manager I like. But am I getting like the same information like in a lot of places, or do you have to really seek out your own and be this investigative journalist that you're kind of mentioning? And then we can get into the rubber of how you go about building that network. But I'm just trying to start to understand the framework more broadly here.
It's a great point. So information disclosure, there's information asymmetry that happens in international markets much greater than in the US. And I would say, the US market has become more efficient over time. So what you're looking for, I would argue, maybe even think about it as an advantage rather than a disadvantage, because you're going to get greater swings of volatility. You're going to get sort of this manic, depressive sort of Mr. Market is going to come through a lot more often. There's greater volatility in some of these markets because there's greater leverage in a lot of them, greater retail participation, less sophisticated institutional investors who kind of can step in and help set prices more efficiently, like could argue we have had in the US with the growth of the institutional investing world. And in terms of specific companies, yes, there is information asymmetry. You can see the reactions of even the US market to things like DeepSeek releasing a new model. I mean, these things don't just happen overnight, but all of a sudden somebody reads a story or writes a research report and that says, "Oh, the new Kimi model is, taking over the world, and so let's sell off certain stocks and buy others." And so I actually would say that, and of course, there's also less analyst coverage for many of these companies. So you'll find that, in companies in Hong Kong or in Southeast Asia, there may be like one or two analysts that cover them. And sometimes they might be, getting good information from the company. Sometimes they might not be super interested in doing it. But I would say that's an advantage, not a disadvantage for somebody looking to gain an edge if you want to do the work. So, language barriers have always been a challenge. For example, in the Taiwan market, when these companies only are required to file their local exchange filings in local language. Traditionally, if you're not a Chinese reader or speaker, it's been pretty hard to get comfortable with that. Once again, one of the advantages of AI is that helps to level the playing field in some of these linguistic areas that you might have faced challenges in the past. And of course, there's no substitute for actually going and experiencing a place firsthand. For example, having spent a lot of my career in China, using WeChat and understanding the power of that platform in the market where literally, you can't order a meal or buy a train ticket without having WeChat on your phone. And you can't pay for something without WeChat or Alipay. And so, that sort of customer captivity is something you wouldn't really be able to understand unless you spent time in China. And it's something we don't have in the US. There's, you could argue that maybe Apple and the iPhone have some of that feature, but the customer captivity and ownership of the Chinese consumer that Tencent has through its WeChat platform is pretty amazing. So those are things that you can really pick up, the asymmetric information you can learn about by spending time in the market. And I think a lot of the barriers that you might face as a US investor are actually becoming lower because of some of the AI tools that you can use. And I think, if you're a good analyst, you shouldn't fear having less analyst coverage of a company. That should be something you should think of as an advantage because your ability to analyze the company on your own should make you able to more effectively analyze the information versus retail investors or local market investors.
Can I ask one dumb question first?
Yeah, go ahead.
If I'm translating it's like an earnings report from a Chinese company, am I going to miss a lot of the nuance, or will it be okay? Like, will I get a good transcript?
Gosh, you read a US 10K filing. There's a lot of language in there that is written by lawyers for a certain reason that may not be obvious to anybody. So I would encourage you to approach it with humility, but at the same time, you can read it. And I would also say, in a lot of cases, work with other people, right? Build a network of other investors that you think can help you. Like if you're looking at a Chinese company, Donnie, give me a call. Let's
Yeah.
talk about it.
Yeah.
You have people that who can understand the nuance and can help you to navigate that in a much more savvy way. So, once again, don't sit in your office in Charlottesville or in Minneapolis and say like that's the limit of my world, and that you don't have the ability to build a network or to ask questions. I mean, investing is such a social activity. It's an ecosystem, right? The markets are an ecosystem, and the more that you can understand elements of that and how other people look at it and the way people process information differently, the better you'll be and the better decisions you'll make.
I like it. Sorry, Jeff, go ahead.
Yeah, I have a question. So when you're thinking about events that are exogenous to the company, and what I mean by that is, say, I might be long a tech firm in China like Alibaba, and fundamentally it's doing what I think it's doing what I thought it was going to do when I made the investment. And then something comes along, like whenever it was 22 or 23, where Xi Jinping decides to crack down on the internet giants, and you see an entire sector sell off, right? And I mean, I didn't see that coming. Maybe somebody with local knowledge could have. Or maybe you're directionally correct on DRAM and you're invested in SK Hynix, but maybe you didn't quite realize, the amount of leverage in that market given all these super levered single stock ETFs. So there's these exogenous things in foreign markets that can take an otherwise correct thesis and derail it. And the same thing exists in any market, including the US, and anybody that thinks we can understand what's going to happen, with Iran and Trump and everything. I mean, who knows, right? But I do feel as an investor, I have a better sense of the exogenous risks in the US than I do in China or South Korea, or even the UK, where I lived for 3 years. How do you think about getting a hold of those type of risks, understanding them in a way that at the very least doesn't put you at a disadvantage, to a local investor?
Jeff, thank you. That's a fantastic question. And I think you bring up two really important elements. One is local market leverage, and the other is regulatory issues that pop up in different markets. And I would certainly argue that both of those can be exasperated in foreign markets versus the US. As I mentioned before, the US market has a deeper set of institutional investors that generally tend to moderate some of the volatility in prices. And in fact, sometimes you can use this to your advantage. I would argue that US investors are probably more savvy to the risks that are associated with highly levered ETFs versus other markets. So for example, you might even find this fascinating that actually the largest ETF in the Hong Kong market, not in the Korea market, was actually a double levered ETF that just did daily double leverage on SK Hynix shares. And so, of course, what happens is that product gets created when there's a bull market in SK Hynix shares and investors want exposure ahead of the US listing. And so as a US investor, you actually, I think, are more prepared to sort of see the risks because you're away from it. You're not hearing your taxi driver in Hong Kong talk about how he doubled his money last week on these shares. And there was $16 billion tied up in that single stock double levered ETF in the Hong Kong market, not even in the home market of Seoul. So
I don't know about
you can
Hong
only
Kong.
imagine
The double levered ETFs in South Korea, I read an article the other day that they actually have contracts for difference on the triple levered single stock ETF. So it's like you can get this massively leveraged ETF and then trade it via a contract for difference, which just implies more leverage. And I'm just like, wow, this is just, but in my mind, it's like if I have a really long-term thesis on SK Hynix and DRAM, I mean, if that thing explodes, because I mean, that's probably providing an opportunity for long-term investors that can take advantage if they understand mechanically what's happening, right?
So exactly, and you can see this happen in trading in the past few days because as we're recording this on July 30th, there was a huge down draw on SK Hynix. By the way, that double leverage ETF is down 80% from its peak, so those investors are getting washed out.
That's crazy.
And I think the stock has been up pretty dramatically today in U.S. trading. because there was some news about a leveraged U.S. fund that just
Yeah.
blew up,
Situational
and
awareness.
Yeah.
Was that the name of it?
situational awareness. Yep.
Right.
So
Right. Yep.
hugely levered long to the semiconductor industry trade, and then of course you had some overnight political issues bubble up in South Korea where there was an emergency meeting among government officials. So what you're seeing there is what looks like it could be appearing to be some sort of a near-term bottom or kind of cascading effect that's sort of run its course. And I'm not saying that what direction it will go in the future, but I'm just saying that, you can see that from New York. All of that news about the leverage building up in the system was covered. You saw the SK Hynix IPO in the US, which helped to make that more clear. So that wasn't really something you couldn't see. You mentioned China regulatory risk, and I think you're referring a little bit to the Ant IPO that was related to Alibaba. A couple things around that. One is when that IPO was canceled, which was a very extraordinary event. That was due to Jack Ma making a speech in Shanghai where he criticized Chinese financial regulators for effectively regulating fintech companies like Ant, which does digital payments, in the same way they regulate state-owned banks. And he compared this to regulating an airport the way you'd regulate a train station. And so that didn't sit well with regulators. They canceled the IPO. And you could have seen that. That was in the Wall Street Journal. That was available information to everybody across the globe. Now, of course, you could have interpreted that differently and going, well, this is not going to affect the core e-commerce business of Alibaba, but you do need to be aware of regulatory risks. And I think that's where you have to have some judgment there about how you respond to those types of informational inputs. I'll also point out that at that point in time, Alibaba was regularly trading at 50 to 60 times earnings. So you're talking about once, an expensive stock that had been on quite a run and a regulatory catalyst that could cause you to reanalyze how you approach that business. So, it's not saying that just look at the business model and buy and hold it for the long term and you'll be fine. You do have to be much more nimble, I argue, in some of these markets because you do have greater volatility, greater swings, and you don't necessarily want to be a short-term trader, but you also need to be nimble and willing to size in and size out of positions based on some of these local market volatilities that can be greater than in international markets. And don't use volatility don't use leverage, in the way that it looks like some of these investors have been caught offsides using too much leverage.
That might be words to live by in a lot of cases, but maybe especially for international. Well, this has been, I think, the first half of the discussion is like this prescriptive path and how you can, begin your beginning journey internationally. And I this is very helpful for me. Is there anything else that you would say?
Yeah, I just wanted to share maybe a couple tailwinds that I think are really, really valuable for investors to think about when they go internationally. One of the first one I always think about is we talked about corporate governance before, and I think the natural instinct is to always talk about it in kind of a negative way, in the sense of like, I can't understand management teams in these countries. They have different cultures, different business cultures. I should be fearful. Well, let me give you a reason to be excited about corporate governance reforms in international markets. So I'll point you to the case of Japan. And, Japan had been through this sort of long period where you could argue a lot of companies were zombie companies, right? They had reached this peak in the 80s and the very early 90s, and then the market kind of crashed and interest rates went to zero. The economy was very sluggish, society aged, and there was a lot of negativity around investing in Japan. And of course, you'd always have a few value investing geeks. I think maybe put the three of us in that category, who would get interested in Japan because they would look at so many cheap companies where they had huge amounts of cash on the balance sheet and, reasonable businesses with good assets. And, we pulled out our old copies of Benjamin Graham's Intelligent Investor or Security Analysis and said, these are Ben Graham stocks, right? These are nets.
Right.
We can make money here. And it would work out in some cases, but not, I would say not overall as a good strategy. And something started to change in 2023. The Tokyo Stock Exchange actually started a policy where they would actually name and shame companies that were trading below 1 times book. So basically, companies that were
in the shame.
Sorry?
Like a wall of shame kind of thing?
They would post it on their website, make it kind of call them out. And basically what they did was any company that was trading below 1x book, they asked them to disclose a plan to raise their return on equity, right? So if you're trading below 1x book, it means you're not earning an above market return on equity. And so companies were actually asked to make those improvements. And that actually was a catalyst for the entire market to do much better. Japan's always had some great global companies, but this really encouraged a lot of its sleepier, smaller companies to really work on improving. And, Japan's business culture is one where responsibility to your shareholders and to the public is something they take seriously, and customers. And so when they started to be sort of shamed by the Tokyo Stock Exchange, it really adjusted the mentality of many, many managers. And of course, it also set off a catalyst where a lot of these companies, when activist investors who they'd kind of ignored for a long time basically became allies of the Tokyo Stock Exchange, it became an issue where now all of a sudden a lot of these became catalysts for sales to private equity or mergers between other companies that would happen at a premium. So that's one example. And then, of course, interestingly,
Pausing
Korea,
on that one, just got to pause on that one because I think there's because my framework for Japan, at least, and this is very rudimentary, so I'll admit to that, is that it was traditionally the business were almost run for the employees and the people of the country. It's just a way of keeping everyone employed, not necessarily for shareholders. But what you're saying is like there's been this cultural change where, in fact, everyone needs to start to really earn their keep in a lot of ways. What do you think the catalyst for that is? It because the U.S. has had this just incredible amounts of innovation, and you want foreign capital to come in, and so you need to have people act like as good stewards of capital towards their shareholders. So it encourages foreign capital to come in, and they need to keep up. Has there been something else that I just don't know that's kind of caused this, and it's just unique to just Japan? You sound like you're going to Korea as well, but I'm just trying to kind of understand maybe the mentality. Just in totality, I guess, but maybe starting with the micro level of Japan.
Yeah, it's a great question. And I think these things build gradually, but I think part of what really happened in Japan was that the government started to look at how do we grow our economy again, right? We need to get out of this, zero interest rate sort of trap. We have an aging population that we need to be able to support with, the growth in our businesses and tax revenue. And we want to be a competitive, country. And of course, stock exchanges live on volume of trading that happens and new listings. And when you look at, for the exchange itself, you look at what their incentives are. Their incentives are to get this, get the market moving again, get people interested in Japan. And in fact, for a long time, one of the kind of main focal points of investing in Japan, and we can talk about Berkshire Hathaway here if you'd like, is the ability to do the yen carry trade, right? Which is to borrow money in yen at very, very low rates, and then to be able to invest that in other markets at higher returns. So a lot of investors were borrowing in Japanese yen and then investing in US tech stocks in dollars. And that's obviously a risky trade because you have a currency mismatch there that you have to manage, but it was effective for a lot of investors for quite a while. And the ability to borrow at low rates and invest with a fully convertible currency was pretty attractive for a lot of investors.
I like good old fashioned greed. The exchanges, they need to make money. So let's get this moving, guys. Come on. So I can understand that. Yeah. Here.
Yeah.
And real quick, just to tell us, when I was in business school, I remember in our operations class, we studied Toyota, like most operations classes. You study Toyota, learn about the Toyota production system. And I was amazed, like this is such an amazingly well-run business. And so innovative, like the operational strategies used with the cord, I forget what they call it, that they can pull and point out at any point if there's an inefficiency in the process. It was almost like an institutionalized version of Elon Musk walking around the factory before Elon Musk was Elon Musk. And I remember pointing out to my professor, because I was amazed at just learning about their operational capabilities. And then I started, I pulled it up on Bloomberg, and I had never really looked at Toyota in too much detail. And at the time, I remember thinking, man, their return on equity is not much to write home about for such a wonderfully run company. And I kind of brought that up to the professor, which he was an operations professor. He didn't have a lot to say about it. But when I think of Japan, I'm like, man, because these are not poorly run businesses operationally, or at least most of them are not. I mean, there might be some, but the Japanese know how to manage a business. And it seems like the fix there is actually fairly easy. I mean, maybe you have way too much cash and you need to buy back stock or pay a dividend. Maybe you've got, just too much corporate fat, that needs to be trimmed. And maybe you have a division that needs to be spun off. But these are fundamentally, a lot of these businesses are very well run. So that seems like just a cool story where it's like, look, with a couple of fixes, we can take these businesses that have historically been low return on capital, low return on equity type of businesses and tweak a few things. Now, all of a sudden, they're earning their cost of capital. They're trading at book or above book if the market believes that they can sustain, high growth at high rates of return. And so anyway, it's a fascinating story. I don't really have a question there, but yeah.
Yeah. No, and I think you're right. And look, I mean, the Japanese market has been a really strong performer in recent years, and it's been driven by a lot of these changes. And of course, it's not just happening at the Toyota level. There's a lot of listed companies that are smaller companies that are really the ones where this change is having a big impact. And Japan's always had globally competitive companies. I mean, you can think about businesses like Nintendo, Toyota, Sony. Tokyo Electron is a leader. There's a lot of leadership in semiconductors.
Fanuc, I think it is the robotics company that
the
industrial robot.
So technology. There's a lot of great businesses there. And maybe maybe it's a good time to talk about the Berkshire Hathaway investment in
the
Japan.
Trading companies, right?
And it sort of dovetails with this period. But Berkshire, and it's actually amazing. I just listened to an interview or a talk that Buffett did where he talked about investing in Japan in the early 90s and looking at that market. But in fact, he was able, in a way that you probably could do to some degree as an individual, maybe through Interactive Brokers or another brokerage if you were a larger account. But Berkshire Hathaway was actually able to issue debt in Japanese currency. So he was actually able to invest in Japan without having a currency mismatch in the way the yen carry trade created a currency mismatch. And I just ran the numbers, and he invested about $14 billion in the big 5 Japanese trading houses. And he was able to raise yen by issuing debt as Berkshire Hathaway in Japan, where he pays $135 million of fixed rate interest payments each year. And for those companies, because of some of these policies and because the trading houses are large conglomerates with relatively low growth, but also high dividend payouts, he's able to generate $812 million a year in dividends. So he's got an immediate, without any price appreciation in the shares, he's got an immediate $675 million a year positive, million US dollar a year positive cash inflow from that investment, which is a pretty neat structural trade to make. And he's bought, he's also able to make sizable investments. $14 billion is not a small amount of money to deploy. And because of the kind of growth of the Japanese market since those investments, those shares are now worth $40 billion roughly.
Well, he spent years
it's been a
telling
very
us,
successful trade.
Yeah, the years telling all of us, don't go abroad. There's plenty of opportunities in the United States here. You don't need to go abroad. And then he goes and makes this epic trade. So he kind of left us on the cold on that one.
Yeah, and I have so much respect for Warren Buffett, and I think maybe it's a little bit on the listener to make sure that you take the principles, but not just the practices. Somebody whose home base is in Omaha, Nebraska is, and in that period of, he's not somebody who loves to travel globally. He's done it, but he's not I would encourage you to grow your circle of competence more broadly than Buffett did. He's got certain tastes and strengths and weaknesses in his personal preferences. And you're right, he will break those rules, which he's done over and over again, like don't invest in tech. And of course, then he goes and makes Apple his largest investment ever. And he argued that was a consumer goods company, not a tech company. But, that seems like a little bit of nuance. And of course, now Google is another huge investment.
She apparently initiated, if you heard that latest interview with Becky Quick.
Yeah.
The initial.
So I would say focus on the principles that Buffett does. Don't listen to his specific dictates on buy this company or buy that company. He also bought IBM at one point, which was not a great investment for him in tech. So he's willing to experiment, and I think you should as well. That's you should grow your circle of competence and experiment. He also invested in BYD. He invested in PetroChina. So he's willing to break a rule when he sees something that's attractive.
Yeah. I mean, towards the end of his life, I think Munger, I think he was having dinners almost every night at his house with investors, and a lot of them were Chinese business owners and investors. And he was certainly the point. They might not have left, but they were bringing people in, and so the curiosity did go
And that's an
broad.
interesting
But
story, Donnie, that you mentioned. I don't think enough people know about Munger's dinners that he was having. I mean, it was multiple times a week, right? And it was always somebody new and
yeah, usually an
right up
international
until he
person,
died.
and
Yeah.
he would, yeah, apparently that was it until late 90s. I mean, it was doing that. So talking about curiosity, but he would, okay, so this has been, I think, a super helpful prescriptive path and to kind of get going, but I'd love to hit some more topical areas. And if there's one, we only probably have time to focus on one geography. You're going tomorrow, Sunday, I believe, to Taiwan, Seoul, some other places as well. So why don't you talk about one area that you find right now particularly interesting? I think there's a lot of questions that Jeff and I have on any topic, but love to kind of hear what's interesting you, especially as you're getting ready for this trip.
Sure. Yeah, it's once again, I mean, I love to travel, and I think traveling is when you learn the most. I think reading is another way to learn a lot about the world. In fact, I'd encourage people who are just curious about the world. One of the quickest ways to accelerate your preparation and make the most of travel or learning is to just pick up like the top books about business in a different country. For example, I'll give a few recommendations. One that I really love is, and Jeff and I were talking about this recently, is Chip War, which talks about the
Right.
global semiconductor supply chain. There's another great book called Apple in China, where if you want to learn about, the role that Apple's played in helping to build the ecosystem within China. And I'll talk a little bit more about Apple here in a second. But then also another one that I really love is it's a book called The Thinking Machine, which is about NVIDIA and the growth of their business globally, but really centered on their connection with Taiwan and the relationship between them and TSMC, which I think is really central. And I think Taiwan is an amazing place to visit. They've got great businesses there. TSMC and MediaTek are two first-rate, well-run businesses. In fact, an investor I admire quite a bit, Richard Lawrence at Overlook Investments, he called TSMC the best-run business in Asia. And so I always look forward to learning more about what's happening with them when I'm in Asia. And in fact, they are one of the most stable semiconductor businesses and growing quite rapidly. And they still trade at, I believe they're currently like forward PE is still less than 20 times earnings. So there's opportunities there. I'm going to spend some time in Seoul, kind of taking in some of what's gone on recently. You will see what the world looks like from Seoul in a week's time, but really interested in that. And of course, Southeast Asia, where I think you can learn some amazing consumer businesses in Southeast Asia and sort of national champions. Like, for example, you can look at some of the retail companies there, and some of them are quite amazing franchises. So I'm going to spend some time there as well. There's a great book about business in Southeast Asia called Asian Godfathers, which it will give you a taste for some of the culture around business leadership. And those are all things you can do in advance, and it's a way to accelerate your learning process. But Donnie, to your point, I'm going to talk a little bit about China big tech, if you don't
Yeah,
mind.
well, I'd love that. That's where I think we all want to go right now. So you can you can have at it, and we'll jump in.
So, just applying this framework that I've talked about, these are companies that are not, esoteric or sort of, off the grid or something you have to like really have some idiosyncratic view on. But I'm just going to talk about Alibaba and Tencent, which are, in fact, they were up until I would say probably around 2020, 2021, they were hot stocks. They traded at huge multiple premiums to their to counterparts elsewhere because investors kind of believed that growth in China would go to the sky forever. And those expectations have flipped, to the sense of you've seen a lot of investors call China uninvestable. And I think US investors, global investors, tend to have sort of a manic depressive or kind of a two-sided way of looking at it that swings between two extremes. So, on one hand, investors will tell you China's uninvestable. the Chinese Communist Party runs the country. I have no way to make any sense of what they're doing. And then the next week they'll say, my gosh, these Chinese companies are so competitive. They're going to wipe us off the map, and they're the best run companies in the world. And so I would just encourage people to really look with a more level head, right? Sort of take these extreme views and sort of, just sort of discount them and just look at the numbers and try to understand the management team and the way they act and how they're incentivized. So one of the frameworks that I like to use, I like to do comparative analysis. So I talked about if you're an analyst sitting in New York or San Francisco, let's say you look at the tech sector, right? And you want to look at China big tech versus US-based tech companies. So Alibaba, Amazon, right? They're two companies that are the most natural to compare, both e-commerce focused. Also, both have built out cloud computing businesses. So AWS is like probably the best business within Amazon, arguably. And Alibaba has been a leader in cloud computing in China. And in fact, they also have one of the top AI models with QN. And so Amazon
pause on that
trades
really quick. I just because I'm the cloud computing side. Are the hyperscalers? They're mainly U.S. I mean, are they competing in cloud computing China? That's not the case, correct? It's really just Alibaba, and then is it Tencent? What's the landscape for cloud compute there?
Yeah, so it's a great question. So cloud computing, there are a number of players. In fact, some of the legacy Chinese telecom companies are competitors. There's also some PE-backed data center companies. One that trades is called, I believe the ticker is GDS, or that the name of the company is GDS. So there are a number of sort of data center providers. I'll just say that Alibaba is one of the leading cloud computing platforms, just the same way that AWS is a leader in that space, but Azure and Microsoft competes with them as well. So, Amazon's trading at, and you could think about different measures, but just to give you a relative comparison, Amazon trades at about 25 times PE, has an operating margin of around 12%. Alibaba trades at 14 times forward PE and has an operating margin of 13%. So you're looking at basically, a business that has a similar margin profile trading at a massive discount. 14 times rather than 25 times. So that's kind of quality of business, price you pay for that quality of business. And then the other thing I find really interesting about Alibaba is that the management team for a long time, first of all, they're incentivized with share issuance. So they took that practice from Silicon Valley. I would say they're probably not as generous as some of the Silicon Valley companies in terms of how much they give to employees of their business. But over the last 2 years, as the share prices come down and the fundamentals of the business have recovered, they bought back $19 billion worth of their own stock. And in fact, one of the things you'll see if you look at it is that, and that's equivalent to 9.5% of the total outstanding shares. So you're talking about in 2 years buying back 10% of the company. That rivals some of the most aggressive share cannibals you'll find. And they've also been, which I find really important and interesting, they've been more aggressive buying back stock when the share price has been low. So you look, I don't know exactly what their internal plans are, but when the stock drops below 100, they get aggressive buying back the shares. And you can see that how the share amount they buy back changes with the share price. So to me, that's a great signal that they're looking to create value for shareholders. And, they're not an SOE, they're entrepreneurial.
By SOE means state-owned enterprise, right?
Exactly. They're not a state firm. They're a company founded by entrepreneurs who have a lot of their wealth tied up in the company. Zhou Tsai, who's the chairman, is actually a Taiwanese person who went to school in the U.S. at Yale University, worked at a Wall Street law firm, worked at a family office for one of the best family-run investment firms in the world. He understands capital allocation, and he's somebody I've spent a fair bit of time with, and he understands the way to make stock prices move and the way to allocate capital. And so that's a management team I'm comfortable with. At that valuation difference, I think there's a pretty attractive setup there. Tencent, I'll move to Tencent here. Tencent, I would say, yeah, you can compare it to Meta. It has some of the features of a social media company. They also kind of run what I would call the operating system of the Chinese internet. And that to me is a little bit more like Apple, where Apple kind of runs the iOS system, the gateway to downloading apps and other platforms. So I kind of look at maybe they're somewhere in between the two of those. Tencent forward PE, which I just find completely shocking as somebody covering these companies for a long time, is currently at around 13 times. earnings. They have a 32% operating margin.
Mm.
Meta trades about 18 times, which probably is cheap as well. It has a 40% operating margin. Apple trades at 36 times PE today for a barely growing business, which shocks me. 31% operating margin. So you're basically, if you take let's say, take Tencent and Apple for this, basically the same operating margin of 31, 32%, you're paying 13 times rather than 36 times. So if it's me, I'm willing to take a lot of other types of risk of regulatory changes or things like that to get that discount with the same quality of business. I'll also note that Tencent also has a team that's really smart capital allocators. They've bought back $25 billion worth of their stock in the past 2 years, which is 6% of their total outstanding shares. So between those two companies, they're buying back pretty significant amount at these prices. And I'll also note that in terms of capital allocation, one of the reasons why I'll argue that they've traded down so aggressively over the past, let's say this year, they've actually come down. There's been no regulatory issues. There's some concern about maybe they're tied up in sort of software rather than hardware. So there's been a shift towards memory and semiconductors away from software. They're sort of software companies, but I would say they're not pure software companies. But one of the reasons is because in Hong Kong, where they trade a lot of volume, there have been some very hot AI IPOs. So Minimax was one of the companies. There's a company called Zhipu or ZAI that did these IPOs that went up, 500%, right? And so investors have moved to these sort of speculative stocks. And, just as I was saying before, one of the advantages of these markets is you have these short-term speculative approaches, whereas as a real fundamental investor, you want to be long-term value oriented. So that's an opportunity. Right. When investors run to these IPOs that have gone up 500x or these memory stocks that are, double levered ETFs, they want to buy into that story and they're taking money out of Tencent and Alibaba to fund those investments. To me, that's a buying opportunity. That's when you want to be shifting your capital against the wind and looking at the market differently. And that's an advantage you can have no matter where you are in the world, right? That's not do I need to be sitting in Hong Kong? Do I need to go and check to make sure everybody didn't stop using WeChat yesterday or people stop shopping online, right?
Yeah.
I mean, let's have a sanity check here, right? These are companies that are going to be around, that are going to be dominant forces in an attractive market for a long time with limited competition for their core value proposition. And I'll also note that you look at Moonshot AI, which we were, Kimi has been a huge story lately. In China, there's a memory company called Chongqing that did a big IPO that, they've gotten a huge amount of investor demand. Tencent and Alibaba are investors in both of those companies. So they own, single digit stakes. So they don't own control of them,
Right.
but they're investors who are going to benefit from the success of these other companies. And DeepSeek, which is another company that people have thought a lot about or created a big shock in the US market when they released a very cutting edge model. Tencent is one of their biggest investors. And so they actually partner with them to offer you DeepSeek on the WeChat platform. And you can also use their own in-house AI platform. So, they're creating a ecosystem around them where they're participating in some of these companies that are on the leading edge, but you're not putting all your eggs in one basket, on betting on which of the AI models is going to win. It's just like, do I want to bet on Anthropic or OpenAI, right? These are both companies that have a chance to be really successful, maybe different areas of the market. Maybe Anthropic is a winner in the, the enterprise, and maybe OpenAI wins in consumer. I don't know what the future holds there, but if I'm spreading my bets around, that's a better chance for me to be successful in the long run. So that's my case for why I think Alibaba and Tencent, China big tech or China old tech, you could even call it, is pretty attractive. Right now, this is not a recommendation to buy those stocks, but just a framework, how you can apply this global value investing framework to understand them. They publish all of their financials and information in English quarterly. They have conference calls that you can listen into to understand the business. They have investor presentations. in English available online. There's plenty of analyst coverage of those companies, and you sitting in Minneapolis or Charlottesville, I think can get pretty smart on those companies pretty quickly and have the ability to take advantage of, companies that are high quality businesses trading at really attractive prices.
Rick, just real quick, and you don't have to go into a ton of detail because I know it might be a very detailed conversation, but the VIE structure, the variable interest entity structure, I know I know some investors are troubled by that. Do you think that's a non-issue, like in terms of, well, do I really own the stock or I own this, through this weird structure? Is that a non-issue to you that maybe is getting overreported? How do you think about that?
And just to add one layer,
Yes.
one layer on that one, is it, especially these larger companies, is it something that maybe it's not as big, but maybe there are situations where you're some micro capish thing that you would want to double check it. But anyways, that just kind of adding on to that.
Yeah. So as I mentioned a little bit earlier, the VIE structure becomes, I think, very relevant when you face a bankruptcy or liquidation type scenario, right? Because really, if you're investing in Alibaba or Tencent because you want access to ownership of their assets, you're thinking about it the wrong way. Right. These are cash flow businesses, right? These are relatively asset light businesses that are generating cash. And your hope is to get paid by the value they generate for you, not through a liquidation or a bankruptcy distress process. You're looking at it as an ongoing concern, a going concern type business. So I think that issue has been overblown. Is there a scenario where if Xi Jinping says, hey, you need to take all these assets and give them to the state? And yeah, you could dream up a scenario where that becomes a real problem. But once again, everything in life is about assigning probabilities to different outcomes. And if you want a zero risk investment, maybe treasury bonds, maybe money markets, maybe cash in the bank,
very short duration,
maybe gold. Yeah. But look, you have to really, instead of taking yourself out of the game by imagining up, some legal scenario where everything goes to zero, you need to, balance out kind of the risks. And, when I say have all 100% of your money in one stock, no, that's portfolio management. These are risk management strategies you have to have. But to say I don't want exposure to it because there's a legal scenario where if everything, goes into a negative scenario, and it's going into bankruptcy and I need to be able to get access to owning the assets of a Chinese tech company, you're looking at it the wrong way. Yeah. And I think, Donnie, just to your other point, you asked about, are there some scenarios? One of the reasons why investors have gotten scared of China stocks is because there was this period. I don't know if anybody's watched the movie The China Hustle or familiar with.
Yeah, I remember it when it came out. That was about the reverse IPO thing, right? The Chinese reverse IPO.
Exactly. So, just to quickly recap that. So Muddy Waters was a short seller that Carson Block, really smart guy, did some really great work on small cap Chinese IPOs that were listed in the US that would basically go by names like China Battery or China Forestry. And they did these reverse mergers, taking advantage of some of the US listing standards, which actually don't require approval. They just require disclosure, and actually have pretty lax standards on some of the disclosures from foreign issuers that they allow. And, they were basically selling a story of, we are China's national champion in forestry or in batteries or in oil or something. And they would just put China in front of whatever product, and they would sell the stock for, $100 million reverse merger market cap company. And look, if you think that's the way to make money off the China market, I've got a bridge in Brooklyn to sell you. That's really where we're targeted towards retail, unsophisticated investors, a few unscrupulous, very, very lower end investment banks were doing these deals with sketchy law firms. That's not the China market. That's not what we're talking about here. That's
to some degree maybe making people weary on everything China? I have this theory that, it's a whole other conversation, but that events like that can have a long tail in terms of how they influence market participants' beliefs on things. So you have an event like that, and it's like, oh my God, these things are all frauds, or a lot of them are, and there's fraud risk, and you can't believe the financials. I don't know what I'm owning. I don't want to touch any of it. And it's like, well, that's actually the reason why you can buy a wonderful business like Tencent or Alibaba at a much lower price earnings ratio than you can an equivalent US company like Amazon or Meta or Apple or whatever. Is that a valid way to think about it, you think?
Completely. I think you're hitting the nail on the head there, which is people have a bad experience and they get burned. You can also argue that investors who bought Alibaba at 50 times earnings, thinking it would grow at 40% every year forever, had the same experience. And so, it's all about just weighing risk and reward and doing the work, not buying the hot tip, but actually really understanding solid businesses. And, we're seeing that frenzy again with some of these memory companies or AI models that are getting valued, and they're selling stock. They're offering stock to the market to meet that demand. And so, it's kind of core to how you need to approach value investing in general, which is, buy with a margin of safety, a business that's high quality, generating cash. Don't speculate on the latest hot IPO, right? And that applies across the board. And I think that's why you have some of these large cap companies that offer a lot of value right now globally. And we're focusing a lot on Asia because I think there's a lot to do there right now, but that's where a lot of my expertise is. But you can find that in other markets as well, where there's kind of some of these companies that are not the hot young thing anymore, and they offer good value that will compound over time.
I like it.
It's a solid pitch. I like it too. I think I've always, I've probably fallen into the trap that a lot of people do, which is, I know it didn't take a genius to know that Tencent's a great business. It didn't take a genius to understand that Alibaba's a great business, or even Mercado Libre, right? I mean, in South America. But, I've always thought, well, okay, it just seems so obvious. I must be missing something, right? It's like, it's so obvious. But sometimes, you're not the only one thinking that, right? And that's, and therefore, what's the joke about the two finance professors walking down the road, and one of them sees a $100 bill on the ground and says, "Oh, look, $100 bill," and the other one says, "It's not real, because if it were, somebody would have already picked it up." I think there's a lot of truth to that, right? And I feel like sometimes things can get undervalued for just simple reasons like that, where everybody's a little hesitant because there are these unknowns. And, we all know that there's a home bias in investing that's been well documented in financial literature. And the undervaluation just could be that simple. You layer into that, the whole scare from, the China hustle, the reverse IPOs. That when did that happen? That was like 2012, 13. Was that when that was going on? So
it was in the mid 2010s was when that became a huge issue.
Yeah, and so maybe all of that kind of combined and just uncertainty, geopolitical uncertainty, keeps people out of these stocks. But that's the
and that's where, like, I think the power of contrarianism is really useful, because you're right, Jeff. Like, every asset is attractive at a certain price, and every asset is unattractive at a certain price. And so part of your responsibility as a savvy investor is control your own mood and how you're influenced by kind of the je ne sais quoi, the kind of the vibe, so to speak, of the world, which is, oh, China's uninvestable. That gets me interested, not fearful, right? I want to be greedy when others are fearful, and I want to be fearful when others are greedy. So when people are launching double levered ETF products on a single stock, I want to pause, right? When people are publishing reports about, new IPOs that are going to put data centers on the moon, I might want to be cautious on that, right? That might not be a 50% up to, a company IPOs and becomes the fourth largest company in the world overnight when it, at 20 times sales or something like that. I don't know the exact numbers on that particular IPO, but I want to lean against that, right? I'm not saying short it, but I'm saying, you need to be aware of the environment that you're within. And that's where I think global investing can offer some really, really awesome advantages for people who can be a little bit less tied up in that speculative fever that grips short-term investors in any market.
Yeah, well, I mean, and you can get diversification. I mean, obviously currency diversification, but diversification on global outcomes. I mean, are these Chinese models going to undercut Anthropic and OpenAI? I mean, I don't know, but investing in some Chinese companies that have exposure to those models and to the overall success of China's tech, ecosystem in general is a decent hedge against, that outcome hurting investments in the US, right? And so, I'm a big believer in having multiple ways to win. And, the thing that strikes me about investing in a lot of these types of companies is it's giving me exposure into areas where if one part of my portfolio doesn't work out, there's a decent chance that part will. And, that's a great thing.
I also feel
completely.
like it's like going back in time and all the value investing books you can actually apply, the lessons, right? The scuttlebutt
Yeah.
methodology, finding things that are
Yeah.
undervalued, that,
Right.
inefficient markets. It just doesn't work anymore in the States almost. I mean, it does. I shouldn't say it doesn't at all, but
It's harder.
it's very hard to find. It's very picked over, but it sounds like there's this broad opportunity for someone who's willing to put the elbow grease in. So I really
Yeah.
appreciate this.
And
This has
Donnie,
helped me. But sorry, go ahead.
just one last thought onto that, Donnie, which is that, expanding your universe of opportunities is never a bad thing, right? I mean, you want to, when you look at these kind of businesses, like you're going like, well, this business feels like that business, but I can get it a lot cheaper. Like, expand your universe, expand your circle of competence. That's all we're kind of saying here is that, you want to have more things to look at and make yourself smarter so that you have more optionality in the way you deploy capital to get the highest returns. And if you look at markets where there's more volatility, consider that to be an opportunity to add some alpha into your overall process, as opposed to owning the Mag 7 and getting the beta.
Yeah, the place to hunt. This is really helpful for me. I know it kind of gets me
Fantastic.
the spark going here, motivated to take a little broader look. And it's interesting because even in our podcast now, I think this is episode 13, 14, wherever it is, and we've had about, I don't know, maybe a third of the pitches have been international. And
Yeah.
maybe Jeff and I will get smart enough to
Eastern
go hunt
European Bank,
internationally. Yeah,
Nintendo,
Nintendo, and now this. So yeah, we'll start listening to the advice we keep getting here, and we'll go hunt. Well, I appreciate this. It's great.
that would be my biggest fear, right? Is that I look back in 20 years and I'm like, man, all the keys to success in investing were all on the podcast and I didn't follow enough of them, right?
Yeah,
That would be like a tragedy. You don't want that to happen.
yeah.
But
So,
this has been great. We could easily keep going. I think we're probably up kind of the upper end of our time. But Rick, if people want to learn more, I mean, what would maybe to kind of just end? I mean, getting smart in these markets. I know you have a couple ideas there, like how to meet people that maybe you wouldn't otherwise be able to meet, and kind of put yourself out there, to get more intelligent on specific international companies in specific regions. And then, so what would you recommend there? And then also, if people want to reach out to you, how can they get in touch? And anything else you want to kind of end with what you guys have going at Fordham? Be great.
Yeah. Well, thank you both for having me on the podcast. It's been a lot of fun. We could probably do this for another few hours, but it's been really a joy to talk about it. And sort of, I always feel like when you have a discussion with other smart people, it makes you smarter. So I always learn from our discussions and the questions that you have. And obviously, both of you have a lot of great experiences in areas of investing that I'm less fluent than you are. So I always enjoy learning and talking with both of you. If anybody wants to learn more about what we're doing at Fordham, we hold a ton of public events. Most of them are free and open to the public, mostly in New York, but we've done some things in Charlotte, in Richmond, Virginia, around the Markel annual meeting. We do events in Omaha around the Berkshire Hathaway annual meeting. You can always follow us and what we're doing on LinkedIn. I think LinkedIn is a really powerful tool. You can follow me. You can follow the Gabelli Center for Global Security Analysis to learn more about our programs that we have upcoming. I would say, I think LinkedIn is a really interesting platform for reaching out to people and learning from people. The quality of people who are highly engaged on LinkedIn is I think it makes it a really rare platform. A lot of CEOs are often there. A lot of top investors are frequently posting or willing to connect. It's also a global community, so you can reach out to people and learn about businesses and see their resumes and backgrounds, and search for people who are involved with companies that you're interested in. So just encourage people to think globally. One of the things you learn as a reporter is that you miss 100% of the shots you don't take. So reaching out to people, if you find somebody's email address, there's a lot of tools online that help you find addresses. Send somebody a thoughtful note on LinkedIn or over email that shows you've done the homework, that shows that you care, that you're polite, that you're interested in learning more. You'd be surprised at how often people have a natural eagerness to help people. I find our students, especially young people, our students who want to learn more and approach it from a perspective of learning. I consider myself a lifelong student, so I'm always trying to learn more. And, the more that you can approach people with humility and open mind and, a genuine interest in becoming smarter, I think people will generally respond to that. And if you build a reputation for that, you can always ask people to recommend you to other people to connect with. So, communities like what you all have built are great for, building relationships across the world. I know a member of Value Seville. I visited with them in Amsterdam, and you'll find people within different communities that you can connect with all over the world. So just encourage people to be open-minded and don't be afraid to reach out to people you don't already know. Follow smart people on Twitter, ignore some of the crypto hype and craziness that you also find there, or politics that you might find there or elsewhere. But learning about the world, learning about business, just don't stop doing it, and read lots of books and reach out to people and have great conversations. It'll make your life richer and make you a better investor.
Well
That's
said.
fantastic. I think that's great advice. And I love you miss all the shots you don't take. That's absolutely so true. And it's amazing what a little bit of effort done the right way will get you. And so I think that's great advice. But Rick, it has been great to have you, my friend. We're gonna have you back. We're gonna have to do this again. Maybe you should be our first repeat guest, right? That would be, I know we can keep this going for sure. But yeah, really enjoyed it. Donnie, any final thoughts on your side?
I do. I appreciate this a lot. Your point about expanding the circle of competence and learning a little bit more. This is definitely in that realm for me. So I do appreciate that. And just excited to kind of do a little bit of scuttlebutt on some things here. So I appreciate it.
Thank you, guys.
All right. Take care.
Thank you, Rick, for joining us. And everybody, thanks for tuning in. Episode 1 of season 2. We're going to have, a bunch more coming out in the weeks and months ahead. So keep an eye on it, and we'll talk to you next time. Thanks, guys. Cool.